Tech giants now dictate the direction of the entire stock market. If you hold an investment portfolio today, you are essentially betting on their servers. You know you need a strategy to handle these massive companies, but financial advice online pulls you in opposite directions. Make the wrong call, and you expose your money to heavy short-term capital gains taxes, dangerous concentration risk, or missed returns due to cash drag. To cut through the noise, we are looking at the math behind 3 major investing debates. This matrix breaks down your choices, how to execute trades, which investment vehicles to use, and the reality of directly owning shares. To actually build wealth here, you have to trade the emotional thrill of actively controlling your portfolio for the mathematically superior reality of passive compounding. There is a deep psychological satisfaction in keeping cash in your bank account, waiting for the market to drop 5% so you can buy in at a discount. But this strategy carries a hidden mathematical penalty called cash drag. This line graph tracks 2 paths over a 3-year period. While your cash sits on a flat line doing nothing, the market historically goes up more often than it goes down, leaving your uninvested money behind. By the time a 5% drop actually hits, you can see that this new discounted price is usually much higher than it was months ago when you started holding your cash. The alternative is dollar cost averaging, where you invest a fixed amount of money on the exact same day every single month. Instead of guessing, you buy at these evenly spaced intervals. You automatically pick up more shares when prices are low and fewer when they are high. You will occasionally buy at the absolute peak. You sacrifice the thrill of timing the market, but you guarantee that your money never misses the long-term upward climb. Next is the vehicle, choosing a broad index fund like the S&P 500 against a concentrated tech or momentum fund. This bar chart compares recent 1-year returns across these strategies. A standard S&P 500 ETF sits around 21%, while the tech-heavy QQQM hit 25%, and the momentum ETF spiked past 43%. Momentum funds achieve those massive spikes by automatically hunting for fast-rising stocks and then rapidly kicking out the slow ones. The trade-off is severe concentration. When you only hold the biggest names, your entire portfolio crashes hard if the tech sector falters. This weight distribution diagram shows how the broader market structurally defends your money. Those top 50 megacaps are balanced on top of 450 smaller companies. When tech struggles, those smaller businesses act as a shock absorber. Buying a concentrated fund means accepting a highly volatile, structurally vulnerable portfolio in exchange for a shot at higher returns. If you want to pick individual stocks, you eventually run into Alphabet and its 2 distinct share classes, Google GOLL and Google. Class A, or Google GOLL, gives you 1 voting right per share. Class C, or GOOG, gives you 0. Retail voting rights are a mathematical illusion. Larry Page and Sergey Brin hold Class B shares that carry 10 votes each, maintaining absolute, unshakable control over corporate decisions. Financially, both share classes operate in total economic parity. They receive the exact same dividends, stock splits, and underlying value. Instead of worrying about voting rights, focus on holding wonderful businesses that compound over decades, rather than trying to flip failing companies for a quick profit. Alphabet expects to spend up to $205 billion on capital expenditures to build out AI, while simultaneously paying a quarterly dividend. These businesses generate wealth without requiring you to constantly trade. Paying a premium for a voting right you can't actually use is a waste. True wealth comes from giving up active control, letting world-class companies grow your money tax efficiently. The right choice comes down to exactly how much time and stress you are willing to dedicate to managing your money. This flowchart maps out 2 distinct paths. On the left is the set-and-forget passive investor. The optimal setup here is a broad S&P 500 ETF paired with an automated monthly deposit. You will never beat the market average, but you are mathematically guaranteed never to underperform it, and it requires 0 daily stress. On the right is the Tech Bull Optimizer, the investor actively trying to beat the market. They use the S&P 500 as a core safety net, but add a satellite position in a concentrated tech fund or directly in Alphabet. This captures the massive upside of AI spending, but you have to commit to a 10-year time horizon to survive the inevitable tech sector recessions. Wall Street makes its money by selling complex strategies that make you feel in control. Pick your vehicle, automate your monthly inputs, and let the businesses do the compounding for you.